Let's see whether the real economy is showing any signs of improvement. We just had the management of VIP Industries telling us that about a 17-18% growth should be possible, and to that extent they are able to see demand. What are the AC guys telling us? Veer Advani, the Executive Director and President, Electromechanical Projects Business at Blue Star, joins us now. Good morning, Mr. Advani. Thanks a lot for joining us. Well, exactly that question to you. How much was third quarter demand better than the third quarter a year ago? I mean, the October-December quarter. How much is January better than the previous January?
Sure. So for the quarter, it was the market grew about 10%. We at Blue Star grew twice as fast at about 20%. We had a good festival season. As you know, that's the second season for AC buying, much stronger than last year. Moving into the fourth quarter, Jan has been again strong, and we're looking at a positive quarter end as well. So things are looking a lot better than they were last year for us.
What about in some of the smaller cities, Veer, the tier 2, tier 3 cities? How has demand been there?
Tier 2, tier 3 is actually even stronger than the metros. What we're seeing is in the AC business, there's a shift to more energy efficient products. Today about 25% of demand is coming from what we call 5-star and inverter ACs. The remaining coming from 3-star and 2-star. We're expecting that to keep growing. In Blue Star itself, we're at already at 30% of our sales are in higher efficiency, and surprisingly, even in tier 2, tier 3 markets, which we had earlier anticipated may not be moving to high efficiency, we're seeing demand there as well.
Okay, well, I'll come back to the demand in a minute. You'll have done extraordinarily well in your margins as well, what with copper and several other inputs getting cheaper. Can you do more, you think? Will it get cheaper to make an AC at your end?
While we have commodity price benefit coming to us, copper, like you said, steel, aluminum, on improvement in our cost to the tune of 3 to 4%. Going into the new year, we're anticipating as we usually do, we're expecting the dollar to continue to move in that direction. Commodity prices, some analysts are telling us, have bottomed out, and therefore we're a little hesitant about forecasting cost further going down in the next year. Having said that, with volume growing, we expect next year's market to again grow. This year currently market has grown by 10%. Next year we're expecting it to grow by 15%. With this kind of volume growth, we will of course see some efficiencies through economies of scale.
Can you throw some more light on the demand in tier 2 and tier 3 cities? What has the percentage growth been, say, in the last 6 months for you? And how much will smaller cities form as a percentage of your overall revenues, say, in the next couple of years?
Sure. So we have been increasing our distribution over the last 3 years. As you know, we've only been growing our distribution over these last 3 or 4 years. So a lot of our growth is coming from newer markets, as we call them, which is tier 2, tier 3, tier 4, and even tier 5 markets. So the bulk of our growth is coming from the smaller markets, whereas even today, tier 1, tier 2 markets will still, of course, account for 50 to 60% of our demand. Going forward, as we expand our distribution further, this ratio should actually change. So it's quite an interesting shift in our demand as we go forward.
Okay, so should we say that for the last quarter, and in fact for, say, calendar 2016, we would be able to do a 20% growth in revenues?
Yeah, so in our current year, FY16, we're on track to do 20% growth. And FY17, we're projecting to do 25% growth. We are planning to grow faster than the market in both years, thereby increasing our market share. It was 9.5% last year. This year will be 10.5%, and next year we're aiming to do 12%.
All right, thank you very much, Veer Advani, for giving us some positive cues on the markets and the economy as well.